Good afternoon, ladies and gentlemen, and welcome to the ZIGUP PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we would just like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Head of Investor Relations, Ross Hawley. Ross, good afternoon, sir.
Good afternoon, and welcome everybody to this online presentation. So with me this afternoon, I have Martin Ward, our Chief Executive, and Philip Vincent, our Chief Financial Officer. For those who have seen our previous versions of this, you know that we try and run this more as a fireside chat than rather running through a presentation. But obviously the presentation is available to you on our website along with a transcript. But we will use some of the slides for that. As ever, this is much easier as a dialogue if people ask questions. So do please use the chat function and the Q&A function, and we'll have a look and to see what we can answer as we run through a number of different themes and topics. But I think in the first instance, I'd like to hand over to Martin to really use the first couple of slides from our presentation, which we gave last week, to really talk about in overview terms our full year results for 2024. And with that, Martin, over to you.
Thank you, Ross, and good afternoon, everyone. Look, this has been a fantastic set of results this year. I'm going to talk to the underlying numbers because that's easier to reconcile for the business. So revenues have progressed up nearly 14% at 1.5 billion. You can see also that's flown through to our EBIT over 213, up 13%, and through to our record PBT, nearly 181 million. So, you know, we've continued to deliver on the strategy that we set out for this business back in 2020. I think every time we've provided an update to the market, it has been a story of growth and good sort of metric delivery. All of this sort of flows through to being able to support a good ROCE return. We're up 4 percentage points there, 0.4 percentage points to 14.5. And we've also been able to increase our dividend, or propose to increase our dividends, which we put to shareholders for this year, taking the full year to 25.8%, 8 pence, up 7.5%. So overall, that's been achieved whilst being able to maintain a debt leverage, which is unchallenging at 1.5 times. So we've invested a lot in the business this year. We've been operationally, we've been very busy, and we've made some great investments in our fleet. The value of the fleet now on our balance sheet is 1.3 billion. So as we make those investments, you see the corresponding value come across in the balance sheet. And then if I just look on a non-financial basis and look at the operational performance, I mean, it has been very busy, and the business has cemented a leading differentiated proposition in the market with a platform of services appealing to a wide number of customers. And it has been an exceptional year for that operational progress. We've added to our rental capability, the broad range of new products and value-added services in both the UK and Spain. And one good example to bring this to life is the acquisition of Blakedale. Blakedale has been a standout performer in the traffic management space, and we have supported growth with investment in their fleet, which is up 35%, new customers up 18%, and operating profit up over 100%. We also support their customers with additional services, including the specialist fit out of key customers, their own vehicles, who trust their expertise in the specialist area. Similarly, claims and services, which is formerly known as the ready side of the business, has grown its specialist capabilities and broadened this offering, including a new out-of-hours first notification of loss and accident vehicle recovery service for insurers, which is seeing growing demand. And our scale has allowed us to do more for our existing partners, including contract expansions and new outsourcing customers, such as Lex and Abakai Insurance, which went live in the year. We also won a new contract to support a long-standing group customer, Royal Mail, with repair capacity and have more opportunities in the pipeline. Investment in automating and digitalizing our systems and processes is a long-term program, but bring immediate benefits. For example, we launched a self-service portal for a direct insurance rental customer, where around 75% of monthly activity is now going through online with no manual intervention. We plan to roll this out more widely this year to other partners. An investment in our integrated repair facilities and independent network, now numbering over 600, is increasing our repair capacity, which remains a scarce commodity. When I think about our broader initiatives, our Customer First program, for example, that's re-energized the team after what has been a difficult period where supply constraint and parts delays have caused real challenges for those on the front line. And looking at the structural trends towards EV take-up in the LCV market, there is positive momentum in the UK and I. The fleet compared to last year is now up over 140%. In Spain, the pace is a little bit slower, albeit with a 16% increase. We've also responded to a changing EV infrastructure market by developing new partnerships with energy providers. These are increasingly the best routes to those looking to install home and workplace chargers. So overall, the progress in financial year 24 was significant and positions us very well for the opportunities ahead. Okay, so look, that's my overview. I'm sure we'll go into a lot more detail, Ross.
So thank you for that. And thank you. I can see some questions already coming in. The way which we're going to do this is to look at certain kinds of themes. So if I haven't asked your question straight up, it means because we're likely to talk about things such as dividend and the capital allocation a little bit later on in the programme. But I think, Martin, just to touch on one thing, just in terms of feedback scores and how important are they to the business and how have you seen those sort of develop and then your feeling about those?
Yeah, look, customer is key. That is a key focus for this business, and we've made sure that everybody sort of understands that. You know, things that we put in place, feedback from customer engagement surveys, NPS scores, Trustpilot, all of these things give us very, very quick feedback around how we're performing as a business. If we get it right for the customers and our partners, you tend to have a very happy business. You know, a good example would be at our branches. I mean, you're familiar with our branch setup. If you walk into one of our branches now, you can see a Q code on the wall. You can instantly scan that Q code and you can give us feedback on the spot in the branch to tell us whether we're getting it right or wrong. So we can see that instant feedback. So we've been able to develop that across our sort of branch network, across our customer contact centres, so we can see where we're getting it right. And it's important to us. As I say, if we get it right for the customers and our partners, we'll get it right all the time.
And it's something which partners do look at themselves, don't they?
It's increasingly important. You know, when you're providing the services that we have across that platform, there's multiple touch points with the partners, with their customers. So they are relying on you to make sure that you are delivering on all the things that you've either promised or the customer would expect. So it is something, you know, that feedback, that NPS scores, the SLAs, the Trustpilot scores, that raw customer feedback is important. So it's something which we think stands us apart from the rest of the market.
And I think, as we know, they're certainly significantly higher than the rest of the sector in terms of things like the Trustpilot scores versus our peers.
Indeed, yeah. Look, we can always do better. But if I look at our Trustpilot in our rental sector, for example, we reported 4.7, which is an excellent rating for Trustpilot for a company. I think that's even gone up to 4.8 more recently. But it lets everybody know that, you know, we are on display for our customer service. We want to get it right. Sometimes we'll get it wrong. Don't get me wrong. You will see 1-star reviews where we got it wrong if you search for them. We want to get it right, and that's the sort of at the heart of what we do, where we put the customer first in terms of our delivery.
Fantastic. So I think, Philip, if we turn to you to just sort of give an overview of the performance in the year, we'll come to cash flows and everything a bit later on, but maybe just talk through some of the slides which are familiar with in terms of that overview on a financial.
Yeah, sure. Thanks, Ross, and good afternoon, everyone. I think I'll actually skip this slide. I think we've covered all of the headline numbers, which overall are all very positive, which Martin talked to, and I'll go to the group revenue waterfall on page 8. And what we can see here is that we can continue to see the benefits of our platform that we've developed. It's continuing to attract customers across all of our businesses, and we had group rental revenue growing at 6.4% across the group for the year. Now, within that, UK and Ireland average VOH actually reduced by 7.7% year on year due to the limited access of vehicles during the year, although it did improve significantly in H2. And the rental revenue within the UK still grew at 4.6% through both product extension, but also carefully managing our pricing to customers. Now, in Spain, the access to vehicles has returned to normal, and average vehicles on hire grew 4.1%. And with careful pricing with customers in Spain, rental revenue grew 8.4%. And claims and services revenue grew 19.4%, and that's benefiting from the full year impact of the new contract wins, which we announced last year, as well as growth from our existing contracts and customers extending their products and services requests from our platform. And then in terms of vehicle sales revenue, that was 312 million, just under 160 million higher than the prior year, as the new vehicle supply improved in UK and Ireland and continued to be strong in Spain. Now, I'll just talk through kind of the headlines on the profits. If we turn to the next slide on the profit waterfall. So this is obviously bridging our underlying profit from last year to the current year of 180.7 million. And we can see here that group rental volumes in UK and Ireland and Spain contributed an additional 6.7 million of profit before tax. And our procurement activity continues to develop in both UK and Spain. And that, alongside careful pricing, meant that we've managed cost inflation across the businesses. And also then alongside extending products and services to our customers and a continued focus on customer profitability as well, we've seen Spain rental margin of 18.2%, which was higher than we expected in the year. And over time, we do expect that will return to our medium-term guidance of 15%, but is likely to be higher for longer still. And in UK and I, that was in line with our expectations. So it went up 40 basis points and was at 15.5%. Our disposal profits decreased 3.8 million in UK and Ireland, as we're selling older vehicles with lower residual values and lower profit per unit. But it increased 14.1 million in Spain, where access to new vehicles has returned to normal. Now, residual values have fallen in the UK and Ireland and in Spain, and that's partly reflecting the older vehicles that are now being sold into the market. But overall, they do remain high compared to what we have seen versus historic levels. And then the increase in claims and services volumes from existing and new contracts contributed an additional 8.8 million in profit. And claims and services earnings before interest and tax margin at 6% reflects the mix effect of the business, all of which contribute to the profits of the business, as well as high return on capital employed. And then the final block there, you can see interest costs increased 9.7 million due to a higher average level of debt and the full year of higher interest rates. And that was offset by a reduction in our corporate costs of 1.1 million. I think the final point I'd like to make, importantly, is that if we exclude all disposal profits from our underlying profits, then underlying EBIT increased 10% year on year. So that continues to demonstrate the underlying growth of the business.
Fantastic. So just looking at some of the questions, William has been asking about the claims and services side, in part just about seeing the growth there. Maybe talk through a little bit of that, Martin, but then also just in terms of the financial disclosure from that. I think just from my perspective, William, if you went to our website, you'll see we did a teach-in in January, which gave a lot more detail to try and explain that the claims and services business. So there's more information there, but I'll ask Philip to comment on that in a moment. But Martin, it's a strong growth prospects, a really good year from claims and services.
Absolutely. You can see, the revenue there from claims and services has grown year on year. It's heading towards £1 billion of revenue. So it's obviously becoming a big part of our portfolio. Now, the key thing here is, I said it last year, and I'll repeat it, what we're seeing procurement teams in the market and the insurance companies and some of the lease cos, etc., where they are consolidating their supply chains. So previously, insurers would rely on a sort of a larger part of the market, in repairs. You could be a sort of mar and par type businesses where you're getting repairs undertaken. Sort of today, that is a much more consolidated position. Insurers are looking in their supply chain for quality businesses that can operate on a national and regional basis, have the right credentials from an ESG perspective, the right credentials, that customer feedback in terms of how you handle them, but also importantly, how you're investing in your platform as well. For example, keeping with repairs, the technology that you're using to do repairs. If you're not using the latest technology, you're not seen as an efficient supplier. There's new techniques out of the market like plastic welding, aluminium welding, ADAS, where you put in that sort of radar into the screens and so forth, being able to do that in-house as well. So there's a lot of areas where it's important that you get this right. And where you get it right, then obviously you stand a good chance of sort of winning more contracts in the market. Now, I've said in our outlook, I talked about our pipeline. Pipeline is very, very strong. We have a lot of tenders on the go at the minute with large, medium-sized insurers and lease cos, etc. And we've got a good sort of conversion rate. So, we're quite optimistic about our sort of future. And that claims and services side, we expect that to continue to grow.
Fantastic. And Philip, just any comments on the margin somebody's asking about there as well?
Yeah, so we've commented on the margin in the past, and for claims and services, you can see the margin is around 6%, and that reflects a mix of businesses. If you were to go back to pre-merger days, the Ready, we're often asked, will it go back up to the 8.5%, 9% the Ready used to operate at? And that all depends on the mix of the business. What we've seen quite a lot of the growth coming from the accident incident side of the business, which is operating at a lower margin, but a very high return on capital employed. So that's a pure mix effect coming through there in the margin on claims and services. But it's all very profitable and all very good return on capital employed for us and generates a lot of cash.
Fantastic. Just want to touch on Spain before we move to the UK and talk about the rental business there. Spain keeps on delivering.
Well, no pun intended in there, was there? No. Indeed, Wimbledon and football. But that aside, Spain has been a standout performer, and it's a record set of results for Spain this year. Vehicle supply did sort of normalise earlier in the cycle, so therefore we've been able to take a good advantage of the supply and the demand. As Philip mentioned, rental rates margin have been sort of stronger, so they stayed higher for longer, and the team there are excelling. So we're very pleased with what we're seeing coming out of Spain, and it looks like the economy definitely is strong. Inflation is still high in Spain, by the way, it's up at 3%, but nonetheless, the economy is strong and doing well. So our outlook on Spain is very, very positive.
Yeah, very much so. Okay. For Rocos, a question which I'll just say, is there any significance in the name change? I think you'd say, yes, there is absolutely.
There is. Look, I made no secret of it when the businesses merged back in 2020. You had two identities in Ready and Northgate. There's 7,500 people in the group. It was important that we retain some identity, so we put the name together. It doesn't sort of flow off the tongue, but it was always the intention at the time to undertake a name change and to try and reflect the services that we put together, the proposition, the platform that we have. It's taken a bit longer than we planned. Of course, we went into a pandemic 3 weeks after the merger. But having got there now, it's been in the oven for some time. Having got there, we've done a lot of work on this to get it right. It's not going to be everybody's cup of tea, but really positive feedback. We took this out to a 3,000 strong focus group. So they didn't know who we were, what we did, and we asked for feedback on the name. So we sort of went through that selection process about what we could secure IP on, what we thought was fresh and modern, what was easy to remember, what kept it simple, how do we want to portray ourselves. And the feedback we got was super, super strong in terms of the emotions and how people sort of thought about the name, where it resonated, and we've been delighted with it. The pictures that we got up there on the slide, we launched that to our leadership conference fairly recently, just before we took the name up per se, and the feedback was very, very positive. As I say, it takes a moment just to sort of understand it, but it evoked all the right feelings and emotions, and the colour, look, feel, modernisation, and it moves us away from that conversation about tell us about the Northgate business, tell us about the Ready business. People now say, tell us about the ZIGUP platform. So that's where we wanted the conversation to go. That's how we see that in the market, and partners and our customers have responded very positively as well.
Yeah, very, very much so. And I certainly, this presentation is in the new slide, in the new format, and the annual report coming out at the end of the month, I think looks absolutely fantastic. But in terms of this year, the name change was almost a culmination of a number of other actions as well, particularly about the One Road strategy and the elements of trying to simplify some of the organisational side.
Indeed. I mean, yeah, one of the things that we did at the same time is that we unified the management teams in the UK and I. So we did have a Reading management team and a Northgate management team. We brought them together. We have a chief operating officer now that sits across all the UK and I and delivers our P&L. And what I say enabled us to do is have that focus on the platform where we can sort of cross-sell, share information, share the leads, deal with the customers as one team. And that's very, very important. So that's resonated very, very well. It also enabled us to sunset our previous strategic framework of focus, drive and broaden, which has served us very well for the last 4 years. That's the framework that we used to deliver all the points around the merger, to deliver the synergies and get the business in sort of good shape. So we've sunset that strategic framework that we've introduced, enable, deliver and grow. And that resonates really well with our sort of refreshed position in terms of delivering the services across the platform. And so we've been able to do that at the same time as the brand launch with the strategic pillars and the management team. So the three things that come together very neatly.
Yeah, very much so. I think if we go back a slide, I think you mentioned something which is the ZIGUP platform. And I think this is really a reflection of what has been achieved over the past 4 years. And there's a question here just about customer retention. But I think maybe if you just talk a little bit about what this platform delivers and actually how you see that customer retention, the length of contracts, etc., being a real strong point for us.
Okay, no, good question. Yeah, look, I mean, the platform is more than just sort of, we want to move away from commoditized services. So speaking about it in the simplest terms, it's easy to talk about rental. In the old days of rental was a piece of metal. And anybody with a checkbook could go out there, buy 1,000 vehicles, open a shed and rent vehicles. And that pretty much was a race to the bottom on a commoditized service. The world has changed and we've definitely moved a lot further forward in terms of how that proposition goes forward. So we talk about sort of a life cycle of events that happens when you undertake mobility, whether you run a fleet, operate a fleet, drive the vehicle itself, whether you're a policyholder with an insurer or the leasing company or through a dealership. So we talk about the life cycle of events, all the things that could occur from the start to the finish. We provide a service into that life cycle. So we'll have a touch point. Either it's integrated, we own the service, we own the sort of service delivery app, the capability, and we can deliver that, or we manage it. But together, we put that on the platform and we can deliver a service to any type of mobility user. And we've been extending the services even since we merged in 2020, added new products and services into that platform, developing the multiple touch points that we have with customers. So to the question, how does that then play out in terms of retention? Well, I think everybody knows that if you've got more than one service proposition into a customer, it tends to get a stickier proposition. If you have 3, it's even stickier, and so on and so on. So we've been embedding technology, we've been embedding our processes, we've been developing the services across our customer reach, and therefore the propositions get stronger and stronger and stickier and stickier. And we deliver value back to end users in terms of the services that we provide. And as a consequence, back to your point earlier about customer service, everything, we get that right, we get the value proposition right, and we have all the service and product right, then you've got a good set of ingredients there to make sort of longevity key and retention key in your contracts. And that's what we're aiming for.
I think that's very true. I think maybe if we just had a look at the enable slide, because I think a couple of questions here about technology, whether it's telematics or whether it's in terms of what we're doing with some other customers here. So Gary, when you're asking about how the digital apps and telematics being received by the market, etc., I think it's something which we've been very pleased and sort of seen quite how many people are embracing that, both on the rental side and within claims and services.
Absolutely. I mean, we use Enable very much about sort of how do we deliver our services into a market, and we've got to move forward in terms of how customers want to interact with us, how we want to interact with them. So there's a lot of sort of platforms and portals that we've developed in the year and continue to develop. We sort of expense these as we go along. There's no one big digitization program. We've got a sort of a plan of work, and we're delivering these in sort of bite-sized formats. But the more we can make it easier to use our services through Enable, if you like. I mean, we talk about, I'll give you one example. I mentioned it, but it's a portal that we use for direct hire. So, when a customer wants to rent a vehicle from us via their insurance company predominantly, prior to putting the portal up there, we would manually do all of those hires. So we'd have to sort of contact customer center with the end user, deal with all the sort of the logistics, arrange everything, set it all up, and therefore consuming their time, consuming our time. But actually, that was one product that was right for self-administration. So a customer now can come on to the portal, they can undertake all of that themselves, they can put everything that they want, they know what vehicle they're getting, when they're getting it, and so on. And it's self-administered. So 75% of all those hires now go through on a digital basis. Clearly, it's an efficiency saving, and clearly customers want to use that portal, and we'll be rolling that out across other partners as well. And there's other things as well, robotics that we've been using in the business. So this year alone, I mean, we've embedded 20 claims processes, core claims processes on robotics. So that means that we've saved hundreds of hours per month per process, where the robot is getting near 100% accuracy in being able to complete what I would call mundane tasks, repetitive mundane tasks, freeing up our staff to do sort of more value-added stuff. So across the piece, there's a lot of examples here, Ross. There's a lot of examples that we can talk about in terms of that sort of enablement. But that's an ongoing program.
Yeah, thank you. And I think hopefully that answers a number of questions just in terms of that digitalisation side of it. I think, Philip, I'm going to come to you in a moment to just talk about that leverage and that cash flow side, but maybe just to tee that up, then Martin, we have a supply and demand slide, and I think it's not a tipping point, but actually I think you've identified that certainly in the UK, supply has started to come back in a number of different ways.
Absolutely. I mean, we've talked about vehicle constraint in the UK for the last couple of years. Post-pandemic, supply chains are disrupted. Very difficult to get hold of new stock. We said last year, the second half of last year, definitely visibility had been growing, and we can see that now. So in the UK, supply is come back very strongly now, so we can see where that product is coming from. And we've got the demand for that product. We've got customers that are waiting to either replenish their fleet or take on new fleet. So, demand and supply is starting to come back into balance. In Spain, we said that vehicle supply normalized a little while back. So we've had the benefit of being able to take on that new supply and meet the demand that we've got. And hence you saw the sort of growth in the VOH, growth in the fleet, growth in the top line.
Yeah, and so one question I think Dean was asking about, a bit of colour around sort of the bundling of electric and traditional vehicles. And we talked about really in the context of the ZEV mandate and OEMs who do have a bit of a challenge as they look forward in terms of what UK regulation is at the moment.
Yeah, that's a very important point. I mean, for those that are not familiar with the ZEV mandate, zero emission vehicle targets. So the UK has adopted a position where any registered vehicles, so if they're LCVs, vans, if you want to call them that, so if they're combustion, 10% of all registrations have to be alternatively fueled on vans and 22% on cars. Now, this is a UK position only, so it's, and the penalty is charged to the manufacturer if they miss those targets, and those targets are going to go up every year. Now, where we can help is that, we have a mixed fleet of vans, we have cars as well, both in Spain and in the UK. So we can take a good share of electric vehicles and hybrids into our mix. So we can help when we're securing orders for combustion vehicles, because we can take and support those sort of quotas. And that's very useful for manufacturers that are obviously having to meet these targets and avoid paying the penalties. And from an EV perspective, for us, our fleet is ahead of the UK car park, both on vans and cars, in terms of what we have on our fleet. We just run ahead of it because obviously we lean into the demand that we see. We don't speculate, we just lean into the demand that we see, and we make sure our fleet is appropriate.
Okay. Stephen's sort of expressing if EVs really take off, is there a risk, and either of you want to answer it, just in terms of the residual value profile, and not one I've heard many people query about, but might there be a real drop-off in the diesel residual value market, the second-hand market, because EVs come on that? What's your view on residual values?
Yeah, go on, I'll take it. Look, I mean, we've seen residual values stay elevated for longer. Is there a risk they drop off if EVs are going? Right? Now, we've got a fleet team that's got 120 years experience between them. And, when we ask this question ourselves, our view is that combustion in vehicles, in a way, become more valuable, because certainly from an LCV perspective, there isn't that product there today that can undertake the work effort needed on a national basis. We're out there, we are supporting a road to zero, we're supporting customers with their transition. We're holding open days for our customers in terms of EVs. They can demonstrate, test products, take them for a drive, do all of that. But the products are not there yet for a national workhorse type vehicle.
Yeah.
So what you're seeing is that fleets are wanting to hold on to that sort of diesel engines for longer, because they can't see a roadmap yet for a vehicle that can undertake all that work. Now, in time, it will come. So no, I don't think I personally, in our fleet team, do not think there's a residual value issue there in terms of combustion engines. We think that actually they'll stay strong for longer because of the fact that there isn't the product there to replace them in the timeframes that we're talking to.
I think that's very right. So, Philip, I think two parts to this. I think first of all, could you just remind us about the capital allocation waterfall? Mm-hmm. And then as part of that, just talk about the role of the dividend, why we chose the growth which we put in the dividend. And then we often get a question about the share buyback and what's the intentions going forward. So maybe first just on that capital allocation waterfall with those.
Yeah, sure. We've got a capital allocation model which we've laid out previously, where essentially initially we will invest organically in the business in terms of growing and maintaining our fleet. We ensure we've got a growing and sustainable dividend for our shareholders. We will then look for opportunities to invest inorganically through acquisitions, of which we've executed 6 since the merger. And then finally, we use share buyback to return cash back to shareholders as well. And in terms of share buyback, what we've got to, we've been running our third tranche of 30 million during FY24, which we completed in the first 2 months of this year. It remains within our capital allocation model and we'll keep it under review. And in terms of the dividend, the 7.5% increase this year, look, it's in line with our policy, and it just represents the confidence which we've got in the future growth and trajectory of the cash which we see coming out of the business from the investments we have been making.
And that policy, I think one of the things which obviously we often talk about is that it's an expectation for a progressive dividend policy, which we
correct. That is correct.
Yeah. Okay, I think sticking with you, give Martin a bit of a breather. Just talking through the cash flow, we've had a lot of questions, not just here, but when we've been talking with meetings. We've talked a little bit more about the cash flow profile and really, looking forward a bit.
Sure.
Can you talk through?
Yeah, why don't I just summarise FY24 and then I can talk through of where our cash flow can head going forward. So, in the year, the ongoing performance of the business improved our EBITDA by 34 million. So we took the opportunity to invest with the increased vehicle supply coming through at 280 million in our net replacement capex. So that's where we are replacing our capex to maintain the fleet size, but also to reduce that average fleet age as well. So the UK came down 1.7 months to 34 months, and Spain's average fleet age decreased 2.6 months to 30 months. So we had steady state cash generation after that increase of 125 million net replacement capex year on year of still over 100 million. We then paid dividends out to our shareholders of 56 million in the year. And we had very little growth capex this year. We did have growth capex in Spain this year, but as we said, that the fleet shrunk slightly in the UK. So net, we had hardly any capex, just under 2 million versus the 122 million last year. So if you look at what we spent in total net capex, both net replacement and growth, we haven't really moved. It's the same amount year on year. Okay. Yeah. Our fleet value on our balance sheet now is 1.3 billion. And our leverage hasn't moved year on year. So our fleet value's gone up over 100 million and our leverage is at 1.5 times. So right in the middle of our leverage range, which we say we'll operate in with 1 to 2 times. And if you were to compare to some of our rental peers, for example, you'll see we're right at the bottom end. Even if we're at the top end of our leverage range, we'd still be at the bottom end of where peers are operating. And then on top of that, you can see the share buyback of just under 25 million, plus 4 million acquisitions during the year as well. Now, what does that mean going forward? Well, we see an opportunity now to accelerate our fleet investment plans. I mentioned already that we're seeing fleet supply returning to normal from OEMs in Spain. And we've seen it in the final quarter of last year, i.e. calendar Q1 this year. We've seen it open up substantially. And we're seeing discounts start to return as well, from which we can obtain. In other words, a like-for-like vehicle is starting to get cheaper year on year because those discounts are returning. With that, a better access to supply, we can see that our total capex spend, so that's both in replacement and growth capex, probably going to grow around a third next year. Now that does depend on what's available to us, how much we defleet, etc. But in those kind of broad parameters, around a third. Now, in doing so, that will enable us to continue to bring that fleet age down, and it could come down to around about 28 months at the end of next year. That's not a specific target we're going for, but you could see spending around a third more could bring that fleet age down. Now, so we'll see higher spend next year. In FY26, we will see that level of capex spend starting to reduce and the steady state cash flow starting to increase, or mid 100 million and growing close to 200. And then once you get to FY27, you really see the benefit of all those investments coming through, and you'll see our steady state cash flow growing rapidly above 200 million, which then gives us an opportunity with that cash to look at our capital allocation model and say, okay, where do we want to continue to invest in the business for more growth? Where do we want to return funds to shareholders?
Fantastic. You mentioned the word growth in there, and then it's obviously something which we think about a lot. So probably a couple of questions on this which have come up. There's one about where Spain might go to in terms of adjacencies. But maybe before, quite a few new locations in FY24 and then some more in FY25. I think we've got some nice pictures of those if you go into a little bit further on. But just Martin.
Yeah, no, I mean, we've been investing in our property estate. So 9 new locations or new sites opened up in the period that we're talking about, and post the year end, we've opened up a further 3 sites. So look, what we're trying to achieve here is we are increasing the capacity. So when we're looking at, there's a couple of things we look at. So if we're relocating from an existing geography or territory, and we're looking for a new site, we're looking to grow our footprint. So we'll be investing in sites that will give us a bigger footprint in the locality, or we are looking for completely new localities where we find it's a good hotspot, we've got plenty of demand and we can fill that. So we've had a mixture of both, on the body shop side of things, on the rental side of things as well, and in the UK and in Spain as well. So we've put some pictures up there in the presentation. You can see these sort of environments are, very modern. So we're equipping them with the latest tooling, because as I said earlier, it's very important that we're able to do that for our partners and use the latest technology to do our repairs. It also enables us to improve productivity and efficiency, because when you open a new site, you set the workflow exactly as you would like to see it. And that does have a big impact in terms of the throughput that you can put through those sites, and as well as increasing the capacity. And also it's a great environment for our workforce and for our customers as well, because these are very well lit, very modern buildings, very friendly, they're not sort of under the arch type repairs and all the rest of it. So this is the type of environment that you'd expect from a FTSE Tier 50. And that's part of our property strategy as we look forward in terms of renewal of leases and new locations. So it gives us the confidence when we're investing not only in our properties, but the people and the training that goes with that we're setting up a really sustainable platform.
And keeping on Spain, having looked at some of those pictures, and just the question here in terms of the Spanish operations, where it might grow to, there's obviously adjacencies there. Valuations are quite high as well, aren't they?
They are, yes. I mean, look, Spain, as I said earlier, is doing remarkably well, and we're very pleased with the performance of the team out there. Yes, valuations are quite high. So, we've looked at opportunities to grow. We look at projects in Spain and adjacent territories. But, yeah, in Spain, I mean, you see the multiples on businesses, private businesses that are owned there, anywhere between 12 and 15 times EBIT and sometimes more. So very different to the UK. So they do value businesses more, I would say, fully in terms of the Spanish operations. And of course, we've got a business in Spain that's growing. I think this year the numbers off the top of my head in sterling was about 80 million EBIT. Off the top of my head, Philip will correct me there, but yeah. So when you look at that valuation metric for a business that we own as part of the group, and you look at our market cap today, I think there's some lessons to be learned there in terms of true value of businesses.
And I think the nice thing is, whether it's inorganic or organic, Spain is just doing extremely well. There's a lot more to go for within the country.
There is. I mean, they've expanded their products and services. It's not exactly the same as the UK platform because it's a different set of services as well, but they have expanded their products and services. We are undertaking what we call open workshops, so we can undertake service maintenance repair on non-Northgate fleet. We're doing repairs with insurers where we've got the capacity to do that. We have a digital platform for a B2C rental, so you can come on a bit like sort of airline pricing, dynamic pricing. So you can use it digitally only, where you can do a rental for a 3, 6, 9 month period on our cars. So there's a lot of things developing in Spain, and it's as I said, it's a great platform that we're very pleased with. Okay.
Good. Sorry, I was just saying something there. Fantastic. I'm just having a quick check to see how we're doing. If anybody's got some more questions, there are certain ones which I think are, I was going to say, slightly technical ones, which I will come back to in terms of rental income versus average fleet values, etc., which we want to just have a look, but we will endeavour to respond on those. So I think, unless anybody else wants to come and ask any more broader questions, I'd almost like to turn to Martin with the outlook slide and just say, let's just think about going forward. We've obviously heard from Philip in terms of the growth opportunities through the CapEx side, but strength of pipeline, I think, is something which you've noted has been really continuing strength and across the group.
Indeed, yes. I mean, one of the examples I've given, and I'll give it here as well. We've seen a record number on the rental side. Particularly, we've seen a record number of companies looking for requests for pricing information, and this is typically in the sort of 200 to 400 fleet. Now, you think what happened there? So these are prospects that own their fleet. So this supports our view about that sort of outsourcing trend. But they've held onto the vehicles longer than they'd anticipated post-pandemic, simply because supply hasn't been there. And it's crunch time now. It's time to renew that fleet. And when they're looking in the market about writing a very large check to purchase vehicles versus outsourcing and using the services like ours, clearly there's a very compelling proposition that we have there. So we're seeing a record number of prospects in our pipeline for that. On the claims and services, which has bigger impact very quickly, we continue to see good size tenders, medium, large insurance companies, dealerships, sort of lease cos. So, that's given us sort of confidence for the future. We've got a very good conversion rate. What tends to happen in the market, if a customer moves, we tend to win the business. Sorry, a prospect moves, we tend to win the business. If we haven't won it, it's because they've stayed put, generally speaking. So with the amount of tenders that we've got on the go at the minute, as I said, I'm very confident about our ability to secure some of those tenders for not only for next year, but for the years to come.
Fantastic. So a question here just about sort of market shares, and it's not something which it's very hard to actually judge, but I think if I turn the question around and say, is there more to go for in each part of the business? Are we taking it off others in the industry, or is it more a outsourcing profile? What's the market share dynamic, would you say?
I could say it's all of the above. Certainly, give one dynamic, as you say, it's very difficult because different sectors, different segments, different markets to sort of give a single answer. But if I look at the repair side of things, there's 4.2 million repairs in the UK alone. Over 2 million of those repairs are insurance-related repairs, and insurance companies are the biggest procurers of mobility and repair services in the market. We're undertaking just over 200,000 repairs, so we're sort of 5% of that overall market. And touched on it earlier about supply chains consolidating. So we're in a great position to be able to capitalise on that in terms of that sort of growth position. And then looking at other services, there is lots to go for. I mean, we're a market leader on flexible rental for sure, but we're still relatively small in the scope of things. So there's plenty to go for, and across the platform and all the segments that we're working in, we see plenty of opportunities to organically grow, and that's what we've proven over the last 4 years as well.
Fantastic. I think we're doing very well in terms of the questions which wouldn't get into having to look at the P&L balance sheet things. So I think from my perspective, Martin, I've heard you talk when we were just launching the ZIGUP that you're very excited about the new brand. I think you can say you're very excited about the new brand and the new year. There's an awful lot to go for.
There is, I think, as I said, bringing the conversation around that sort of platform of services, the conversations we're having in the market, the way our sort of people are lined up to address that market, and what we're seeing, it does fill us with confidence because, as I say, it's just not a single product conversation. It's about those services, as I say, on the platform, and it's a differentiated position, and we're in a very strong position to take advantage of it. So yes, I look forward to this year with a great deal of confidence.
Fantastic. So look, thank you, Steve and Ted. I will respond to your questions on certain things a little bit later on. But thank you very much for coming and joining another of our investor meet elements. Since I'm heavily involved in the website, I would say do please go and look at the website. We work very hard to provide some fact sheets, to provide some more information on the company. There'll be some more videos going on up there. So hopefully it's a very useful source of information for you on that. But always do feel free to reach out and give us some feedback as well. So I think with that, Jake, if I can hand back to you to close down this session with your final comments.
Perfect. Absolutely. Ross, Martin, Philip, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ZIGUP PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.